and action. Okay, let's now get into the dynamic yield curve or yield curve dynamics. Okay, we're going to start off in 1998, 1999, and 2000, which was the peak phase of the business cycle. We have 2001, 2, and 3, which was the recession of the trough. We had 4 and 5, which was the recovery growth period. We had 2006 and 7, which was the peak, and then decline. We had a recession in 08, 9, 10, and 11. We had recovery in 2012, growth in 2014, and it looks like we're in growth and or peak in 2015. Here is the yield curve juxtaposed against the Standard & Poor's Stock Market Index, which is a leading indicator. As you can see, in 2000, 1999, 1998, we were approaching the peak. The Federal Reserve had sold bonds, driving down bond prices and interest rates, so it's almost a flat curve. And then let's get going and show you what the Federal Reserve did. So as we start to approach the peak, it looks like the Federal Reserve is selling bonds, driving down bond prices, driving up interest rates. It's still somewhat normal, but you can see as we get to the peak, the Federal Reserve gets really aggressive, starts selling bonds, driving down prices, and then drives up the interest rates and inverts the curve. And then as you see, the market peaks, and then we start falling into a recession and falling stock prices. Then the Federal Reserve starts to come in, they start to buy up bonds and start to drive up bond prices and drive down interest rates, and you can see how much influence they have on the short end of the yield curve because they're buying a lot of bonds, driving down bond prices, driving up bond prices on the short end, driving down interest rates, and really steepening the curve, but yet it's normal. And you can really see at the bottom how the Federal Reserve really steepens the curve. I mean, look how steep that curve is. Then once the transitory and transmission mechanisms of low cost of capital work its way through the economy, consumers start to borrow and buy more, corporations start to borrow and invest more, and the economy starts to move into the recovery and growth phase, and the Federal Reserve starts to sell off bonds to cool the economy, to regulate it, until the economy starts to overheat and you start to see manifestations of asset price bubbles. Here's the Fed selling off bonds, driving down prices, moving up interest rates, and inverting the curve right before the peak. And it looks like they inverted about a year before this peak. It wasn't as long in advance here, but it was here. Then you start to see, once we go falling into a recession, and this was a very severe financial crisis, a very severe recession, the Federal Reserve moved in very aggressively, started buying bonds, driving up bond prices, and driving down interest rates to zero interest rate policy. Then, because of the severity of the recession and the overcorrection in the market, the Federal Reserve moved in after it, bidded up bond prices and drove down interest rates on the short end, started to come into the market and started to buy bonds along the curve, the long end of the curve, and started bringing down medium and long-term interest rates to spur capital investment because 5-year, 7-year, 10-year bonds are used for plant and equipment financing. And then you can see as we move into the 2011, 2012, still very low interest rates, zero interest rate policy that continued to a point in 2013 where we basically broke through the S&P 500 price resistance line. So now we broke through, interest rates on the short end are still pegged at zero, longer and medium term interest rates are still low by historical standards, and the question becomes, when will the Federal Reserve start to see overheating in the economy, start to try to mitigate the asset price bubble that seems to be formulating in the stock market and the real estate market? When will the Fed start to raise interest rates? Well, I think from our discussion today, it would probably be after the 2016 election. It usually takes a year or two for rising interest rates to have an impact on the economy. So you're looking at 2017-18 for a potential recession. As we figured out, inflation's low, import prices are low, the dollar's appreciated, foreign currencies have depreciated, which will also keep inflation expectations low, interest rates low, and maybe push us out to 2019-20. But based on the thesis and the research that I've done, we've had recessions or recession in the first 5 years of every single decade. If that's the case, we're looking at a recession between 2021 through 23, and we've been in the growth peak phase of the business cycle in the last 5 years of every decade. So I think the 2019 to 20 period may be a last of the business cycle growth peak phase, recession 2021 through 23, recovery 2021 through 25, and we'll probably be back in growth peak in 27 through 29, and then back into another recession between 2031 and 33, and then it goes all over again. It's pretty persistent. You can use this thesis and this theory for operational strategic planning, tactical planning, and strategic planning.